Janad Trust here. So Zillow has issued a huge warning, and I'm going to break that down in this video, alongside with how to maximize the opportunities during this looming housing market collapse that's happening strongly potentially this year. So let's get into it. So Zillow, we know that's the popular housing app, and all that kind of stuff. So Zillow has issued a significant warning regarding the US housing market, right? Marking a notable shift in its outlook from previous months. So the company now forecasts that national home prices will decline by approximately 1.7% to 1.9% between March 2025 and March 2026. So this is a reversal from earlier projections that anticipated price growth for the year. Now, this makes Zillow full-blown housing market bear for the first time in the current cycle. So, Zillow projects home values will fall by 1.7% to 1.9% nationwide over the next 12 months instead of the modest increases forecasted earlier this year. Unlike previous forecasts that saw only select markets declining, Zillow now expects home prices to decrease in every major metro area, with the largest predicted drop in San Francisco at 5.2%. There's the increased listings that are giving buyers more options and bargaining power, contributing to downward pressure on prices. Elevated mortgage rates expected to end 2025 near 6% to 6.5%, and high home prices up over 40% since the pandemic continue to suppress demand, with many potential buyers opting to rent instead. So sellers are cutting prices at record levels to attract buyers, reflecting the shift in market dynamics. So despite falling prices, Zillow expects existing home sales to rise 3.3% in 2025 compared to 2024. So this is basically reaching 4.2 million transactions, as lower prices and potentially lower rates could improve affordability. Now, single family rents are projected to rise to 3.1%, while multifamily rents will, increase 2.1%, both slower than recent years, as more would-be buyers stay in the rental market due to affordability issues. So Zillow's downgrade is notable because the company has historically been more optimistic about housing trends. This bearish turn signals broader concern and aligns with other forecasters who now see the days of big housing gains are over. The main drivers of the forecasted decline are a combination of higher supply, persistent affordability changes, and uncertain economic conditions, including the potential for higher unemployment and stagnant wage growth. So while Zillow is not predicting a housing crash, the company is warning of a broad-based correction, with the potential for deeper declines in overheated markets such as Florida, Texas, and Colorado, where inventory spikes are more, they're most pronounced, right? The cities that are expected to be hit hardest by the housing market decline in 2025, this is kind of based off of, this trend, right? Let's give into some of the, city, state, and key risk factors. So we have Tampa, Florida. The key risk factors are the oversupply, insurance crisis, and affordability. Winter Haven, oversupply, the cooling demand. West Palm Beach, high insurance, natural disaster risk. Phoenix, slower population growth, oversupply. Tucson, Arizona, similar to Phoenix in the sense of slowing, population growth and oversupply. Austin is price drops, oversupply. Northport, Florida, price drops, high inventory. Palm Bay, aging population, oversupply. Boise, Idaho, job losses, overbuilding. The Atlanta, the suburban areas, overbuilding, flat population growth. Salt Lake City, rising inventory, affordability crisis, right? New Orleans, significant price decline. Now, Zillow has a history of revising its, housing market forecast multiple times within a single year. For example, in 2025, Zillow's 12-month home price forecast shifted from 2.9% positive in January to 1.1% positive in February to 0.8% positive in March, and then to a projected negative 1.7% by April. So this pattern of frequent downgrades suggests that Zillow's forecast can be highly sensitive to changing market conditions and may lack long-term reliability. So Zillow has often been more bullish than other forecasters, sometimes overshooting with optimistic projections, only to reverse course as new data emerges. So this tendency can lead to significant discrepancies between initial forecasts and eventual market outcomes. So Zillow's widely used Zestimate tool, which estimates individual home values, is generally more accurate for homes listed on the market, the median error rate of 2.4%, than for off-market homes, median error rate of 7.49%. However, even for on-market homes, about half of the time the estimate is within 4.3% of the actual sale price. And in 13% of cases, it can be off more than 20%. This highlights, that while Zestimates can provide a useful starting point, they are not precise enough for critical financial decisions. So, industry experts and consumers often caution against relying solely on Zillow's forecasts and Zestimates for major decisions, noting the models cannot account for unique property features or rapidly shifting local market dynamics. So real estate professionals emphasize the importance of local expertise over algorithmic predictions. Now, I also wanted to discuss how to maximize, how you can maximize the opportunities of this looming market collapse that is expected in 2025. Some of the key strategies that you can use to capitalize on the housing market downturn is, number one, you can target overbuilt and or oversupplied markets. So some markets, particularly those with a glut of new construction, such as areas with high numbers of speculative homes, may see localized price drops. There's also monitoring regions with high inventory, so like the 481,000 new homes for sales as of January 2025, the highest since 2007, can present buying opportunities if prices soften, further. Number two, you can focus on distressed properties. So basically in any downturn, foreclosures or short sales typically rise in affected areas, so buyers with cash or access to financing can acquire properties at below market prices. You can also explore alternative housing investments, so build to rent up, communities, co-living spaces, and study, basically student housing are gaining traction and may offer more resilient returns than traditional single-family homes, especially if affordability remains a challenge. The next one is leverage off-market deals. So with competition easing in some markets, investors can negotiate better, deals directly with sellers, especially for new builds where developers may offer incentives to clear inventory. You can prepare for lower mortgage rates. So if mortgage rates fall, as some experts hope, more buyers may enter the market, potentially stabilizing prices. However, if rates remain high or rise, this could further depress demand and create additional buying opportunities for those with cash or flexible financing. So most analysts do not predict but who could have predicted 2008, right? Most analysts, quote unquote, do not predict a nationwide housing crash in 2025, but that doesn't mean we should still not be prepared, right? Instead, expect regional variation and some markets experiencing declines and others remaining stable or appreciating. If home price growth continues to outpace wages, affordability issues may worsen, but this is more likely to lead to stagnation than a dramatic collapse. So changes in interest rates, government policy, or a sudden economic downturn could shift market dynamics, but these are difficult to predict. So, analysts, sometimes they're right, sometimes they're not. So that's what I have for you today. Please take a moment right now to hit that subscribe button and the like button. If you appreciate this video, if you gain value from this video and you want more videos like this, please let me know that right now by hitting that subscribe button and the like button. See you on the next video.